I'm going to bring in Kingsview Wealth, their managing CIO, Scott Martin. Scott, all right, so we had a shaky start. There's no doubt about it. I think a lot of that was profit taking. But since then, the market has been resistant to going down. Even today, I thought we were going to be down a lot more. What's holding us up? Because earnings certainly aren't.
They definitely aren't, Charles. It's the fact, too, that I think the market is looking at things for, as we have the last several weeks now, Charles, constructively instead of poorly, instead of negatively, and finding reasons, like you said, to keep the selling going. There's been buyers out there that are looking at things kind of optimistically and opportunistically to say, okay, even if we have a little pullback in some of the big tech stocks, sometimes in the semis, sometimes in the consumer discretionary names, those are actually long-term buying opportunities, and that's something that will eventually elevate price.
So there's tug of war right now. It felt like everything was revolving around everything has been revolving around buying yields, right? After that 10-year went from 5 to under 4, it was like a free-for-all. We now see just fund managers, asset managers, active managers, everyone's clamoring to be long, and I think it's provided something of a support here for this market. But if that starts to break down, if this bond yield, let's say the 10-year goes to 4.20, 4.2, 4.3 or higher, do you see the overall market beginning to collapse?
I do, but here's the thing about bond yields, I think, right here, Charles. I agree with you. I think bond yields got a little bit too sanguine, as they did from dropping from 5 to 4, and equity markets, too, got a little bit too sanguine, getting too excited about things. But let's face it, if rates can just stabilize somewhere, maybe it is 410. My particular number is yours as well, is 420 or so. I think that number is a number where if rates can just hang around there, not be so volatile, not be so, say, incalculable, the markets, as far as the equity prices, will say, okay, we can deal with this because we know our borrowing costs going forward. And that's, again, with the backdrop, Charles, as you talked with Jim Bianco there, where the Fed is likely out of this game. So whether the Fed cuts or not, it's still the fact that they aren't going to hike anymore, and that's something that equities should be excited about.
All right, real quick before I let you go, speaking of equities, a couple of names that you like, Waste Management and UNP. What's going on? Why do you like these? Are these sort of ports in a storm for you right now?
They are complete beacons in a terrible storm or in a terrible Arctic outbreak like we've had, or a snowstorm even like we've had across the country. Charles, when things get poopy in the stock market, buy Waste Management. I know that sounds like a joke. Strong balance sheet, good cash flow, small little dividend on that name. It's a great one to hold while the equity markets get volatile. Also, UNP, Union Pacific's one where cargo loads are up, costs of shipping are up, and so are margins for UNP. And so that's an area, too, that you can count on here in the first quarter as things may get a little bumpy as we go into earnings season.
All right. And Scott, of course, introducing a new technical term, when things get poopy in the stock market. Scott, my man, thank you very much. We'll talk again real soon.
Use that one. See ya.
I will.